Welcome back to the second half of the Future Show here on the TD Ameritrade Network. Traders were just 60 minutes ahead of the cash open here in the U.S. And so far this morning, we've been talking a lot about indices and commodities. That means it's time to get into the currencies this morning. We've invited the founder and chief strategist of Path Trading Partners. We've got Bob Iaccino here with us to help take a look at the currencies and the dollar. Bob, I want to thank you for giving us part of your Tuesday morning and get right into the U.S. dollar because it seems to have mostly shrugged off the Trump tweet. It mostly, well, for the most part, it's holding right around the lows that we saw into the end of last week still.
Yeah, I mean, I'm not sure how the dollar was supposed to react to that, and I think that has quite a bit to do why it shrugged it off. If the tweet were an actual action, let's say, if we were to get tariffs as of Friday, $325 billion worth of products, 25%, if we were to get those, what would the dollar do? Would we look for a slowdown and look for a weaker dollar, anticipating that the Fed could potentially cut rates? There are people out there who thought that President Trump's tweet was actually aimed at the Fed. I think that's a little bit of a stretch. But I don't think the Fed would do that. I think the market's a little bit insane, and I talked to Oliver about this yesterday, to be pricing in any sort of rate cut at all when we just had 3.2% growth. We just had the EU beat their GDP estimate by a 10th. We had China recently beat their GDP estimate by a 10th. So granted, if we don't get any movement, as a matter of fact, if we get negative movement, as the tweet implied, on the trade talks, then I guess we could see a little bit of a slowdown, but we're currently not in that situation.
Yeah, I mean, Bob, what you just said makes a lot of sense when you consider the fact that in reaction to some of the Fed comments over the last few weeks, we had seen rates come off significantly, but for the most part, the dollar remained firm.
Well, I mean, the Fed's been saying for quite a long time they wanted to normalize rates. And with what everybody's calling the pivot, you saw some pretty influential Fed members say we're at neutral now, so rates are normalized. What would it take for the Fed to turn dovish again? I mean, if we're at normal, there's two ways they can go, dovish or hawkish. And currently, I think the market expected them prior to last week's meeting to turn more dovish. And that was one of the things Powell almost literally said. He didn't say it, but you can paraphrase, you can extrapolate to say that he was telling the market, look, calm down, we're good where we are, it may be extended a little bit. I believe it was Harker yesterday, and I could be wrong on who said it, but it might have been Harker, he spoke yesterday, basically said he sees one rate hike in 2020, and that's about it. So, I mean, again, that's a stretch. If they could pivot in December, certainly Harker's mind could change before 2020. But I think pricing in an ease is a little silly, and I think the dollar is probably right around where it should be until we see more data.
Yeah, well, especially when you consider some of the data that we've been getting out of Europe. We talked about that at the top of the show, how it continues to be not necessarily very robust, to say the least. Bob, while the dollar's been somewhat limited, holding near these highs, the Aussie saw some movement as of recent in reaction to the RBA, that's the Bank of Australia, their decision to leave rates unchanged.
Yeah, I think when you look at the commodity-based currencies, it's going to be tough to get those out of a hole until we see some strength in commodities, crude, copper, iron ore, aluminum. Palladium's got a little bit of underlying strength. It always does, though. So until you see those commodities start to get a little bit of strength, it's going to be difficult to see that. And obviously, Australia operates in a part of the world where you have to deal with China. You have no choice. Yeah. So if China is slowing, Australia is going to slow as well. But looking again toward the Canadian dollar, same thing, right? We're not going to see a move well above 75, 76 versus the U.S. dollar until we get some movement in crude oil prices. And that obviously is tied to the strength of the global economy, not necessarily just our region. Unlike the peso can actually rally as U.S. data gets better, and we saw that on the non-farm payroll side of things. We saw a really strong move in the Mexican payroll when we got that surprisingly strong non-farm payrolls here in the U.S.
So, Bob, it looks like in addition to the Aussie dollar, the 6N, that's the New Zealand dollar, also moved in reaction to the Bank of Australia, again, on ties to and the close proximity and as far as trade and the global economic conditions here discussion. But is there any indication from the RBA in terms of what we can expect this week from the Bank of New Zealand?
I think it'd be hard during this type of an economic environment, a global economic environment, for those two to diverge. People, I'm sure, realize this, but one of the stronger correlations in the FX markets is Aussie to New Zealand relative to the US dollar. Yeah. I mean, the two do definitely diverge a little bit amongst themselves, but by very small percentages. They tend to move in sync better than any other currency pair when you look at it against the US dollar. So in this global economic environment, it'd be difficult for those two to diverge. It's different if we have a complete free trade environment to where New Zealand could potentially outperform Aussie or vice versa. It's going to be difficult to do that in this environment.
Bob, economic data out of Europe, for the most part, we had been getting a little bit, seeing some optimism as some of those numbers over the last few weeks had been showing, well, at least the bottoming effect, or potentially that the worst was in the rearview mirror. But it looks like as of this morning, in terms of some of the factory orders and the EU revising growth forecasts lower, maybe not so the case. But I think this just speaks to how one data point does not a trend make, and how it could take a little while to determine if we've really kind of worked our way out of the worst in terms of some of those economic conditions we've been seeing.
Yeah, Ben, as usual, you, I think, clarified it for your viewers. The word bottoming is the best way that I would use that. And as you know, as a trader yourself, bottoming can take quite a long time. Yeah. Some of the positive news we saw last week was outperformance in GDP and CPI in the EU. But remember, those were versus analyst estimates. And analysts can be a little bit more pessimistic, but that doesn't mean that we're all of a sudden going into a growth phase for the EU, as you saw this morning. We also saw decent German factory orders last week, which might imply a little bit of strength coming in the future in the factory orders number for the EU. But that bottoming process can take quite some time. That's why I'm not very constructive on the euro as a currency itself. I think getting well above 113 is going to be extremely difficult for the euro until you not only get outperformance from analyst estimates, but closer to some of those ECB targets, which we're quite a ways away from a 1.6 CPI for the EU.
Yeah, it's definitely been struggling with that 113 level throughout the spring. Bob, really appreciate you joining us here for a look at the currencies and helping us break it down in terms of some of the dollar activity, reaction to some of these numbers recently, and tweets from the president. Really appreciate it. Traders, that's Bob Iaccino.
Always good to be with you, Benny.
It's a pleasure to have you, Bob. That's Bob Iaccino, founder and chief strategist at Path Trading Partners.